Darius McDermott, ignore Asia dividends at your peril. It's almost impossible to talk about Asia without mentioning trade wars. They have, alongside Brexit, characterized the political uncertainty that has dominated the global economy. We see positive and negative stories in the press every single day, and the latest development is the two countries signing an agreement, the so-called Phase 1 deal, to pause the trade war for the time being. But the truth is that a permanent solution is unlikely to be found in the next year or so. China, despite its own economic slowdown, is only going to grow as a threat to the United States' leading role on the global stage. A lengthy wrangle is an unwelcome scenario for both countries, as it could see a slowdown in business investment and capital expenditure. In October, the International Monetary Fund said as much when it highlighted the prolonged global policy uncertainty, distorting trade measures, and growth deceleration in the economies of important trading partners, as key factors influencing the economic growth in Asia and the Pacific. It said growth in Asia is expected to moderate to 5% in 2019 and 5.1% in 2020, a figure which is lower, but still ahead of the global figure of 3.4% for 2020. Asia has always been a hotbed for investors looking for growth, and who can blame them? This year the region is expected to overtake the GDP of the rest of the world combined, and is expected to account for 60% of GDP in 2030. Geopolitical concerns may only slow, rather than stop, what appears to be an irreversible trend. But are investors missing out on the income opportunity by being pure growth hunters in the region? Perhaps so, given a recent article by Schroders which alluded to the fact that despite the focus on capital appreciation, 2/3 of the long-run equity returns in the region have historically come from dividends. Why is the dividend outlook improving? As the above figure suggests, the case for dividend investing has always been there, but there have also been economic and political changes that make the focus on dividends in Asia more attractive than ever. The first is that many central banks in Asia have followed the global trend by being more dovish and cutting rates in 2019. This was an attractive move at a time when geopolitical uncertainty has hampered growth. There have also been numerous attempts by various governments in Asia to cultivate a better environment for dividend payouts. Examples include the Shanghai Stock Exchange encouraging companies to pay more than 30% of profits as dividends in 2013, Korea introducing a penalty tax on excess capital holdings to promote higher dividends in 2014, and the Securities and Exchange Board of India making dividend policies mandatory for the top 500 listed companies in 2016. The result is the income opportunities are increasing. At a recent Me for more on this story, visit the news article link.